You may have seen some of the eye-popping headlines of the rent increases that Americans faced in 2021 and 2022. Certain individuals saw their rent skyrocket by 20, 30, and even 40%. Many people wonder what caused this phenomenon, and more importantly, what does the future hold for the renters in the cities that saw the largest increases? From 1985 to 2020, the average increase in rents per year in the United States totaled 2.6%. However, for the year ending January 2022, rents increased by about 17.6%, reflecting a growth rate that is nearly 7 times the historical average. Some cities were more affected than others. At 30% growth, Miami and Tampa lead the 10 cities with the highest year-over-year rent growth in 2021. A majority of these cities are Sunbelt markets that experienced substantial in-migration since the start of the pandemic, therefore increasing housing demand and burdening housing supplies that were unprepared to take in these new residents without creating a material housing shortage. But does this migration paint the full picture of what led to the rapid increase in rents? The following map, which shows the 10 cities that saw the lowest rent growth, shows that there are other factors at play. Populations in these cities are estimated to have been relatively flat or even decreased in some cases over the time period. However, each city saw rent growth that outpaced the historical national average rent growth of 2.6%. So what explains the rent increases in these cities? While there are many variables at play, it all boils down to one simple dynamic. The number of renters has increased and the supply of rental housing has not been able to increase with demand. So what is driving this unprecedented increase in renters? First, it is important to understand that renting and the cost of owning a home have a closely linked relationship. As the relative affordability of one decreases, owning a home in this case, the appeal of the alternative increases. As of January 2022, year-over-year home prices increased by nearly 20%. However, as earnings increased by 5.5% over the same time period, only about a quarter of the rate of the increase in home prices, many had no choice but to rent. Some factors leading to this increased demand for single-family homes include record low mortgage rates, no longer needing to be near dense urban areas, and a pandemic-driven desire for more space. The demand for single-family homes also increased dramatically across the investment community. The following table shows examples of institutional ventures aimed to invest in single-family housing. As renting out residential real estate, or even holding and realizing the appreciation, became more attractive compared to other investment alternatives, an increasing number of these investors began to appear. The use of debt drives returns for investors, and real estate represents one of the asset classes where debt is most attainable. That dynamic, combined with record low rates, led more and more third-party investors to purchase homes. In the first quarter of 2022, investors purchased a larger share of America's homes than ever before. They purchased a record 20% of homes that sold in the first quarter, up 30% from 1 year earlier. The following cities saw the largest share of homes bought by investors. They may look familiar, as the cities in red also appeared on the map of the cities that saw the highest rent growth in 2021. Another factor impacting the supply-demand balance has been an increase in the number of people seeking housing within the United States, which puts pressure on both home prices and rental rates. This is not necessarily population growth, but a larger number of individuals or groups seeking individual housing units. From the low point of COVID through the end of 2021, 4.5 million households were created, and 82% of those new households reflected single-person housing, a segment that is more likely to rent. This increase could be driven by a variety of factors, including people moving out who had previously lived with their parents, a relatively strong economy and tight labor market leading people to choose to spend more on rent and live alone, or a COVID-driven lifestyle change, increasing the desire for more private space as working from home became more prevalent. As a result, the number of housing seekers surpassed the increase in housing units during that time, creating a supply and demand imbalance. In a perfect world, the new construction of both single-family homes and apartment communities would increase to meet this elevated demand for housing. However, COVID-driven supply chain issues and labor shortages led supply to lag demand, and housing prices stayed elevated. In the second quarter of 2021, lumber prices increased by nearly 300% compared to the beginning of the pandemic, and steel increased by over 200%. This stalled construction as many builders opted to wait out the volatility in hopes that prices would normalize, or abandoned starting new projects altogether. On the labor front, not only did positive COVID cases cause entire construction crews to quarantine in the early part of the pandemic, therefore delaying projects, but the industry has simply had trouble finding enough qualified workers. A study in the first quarter of 2022 by the Associated Builders and Contractors Trade Association estimated that the construction industry was short 650,000 workers. These factors restricted the construction of new housing options in the U.S. With limited for-sale home availability and pricing that exceeded affordability standards for much of the nation, renting was the more attractive and perhaps only option, putting upward pricing pressure on the rental market, which was also affected by these same construction and supply challenges. Luckily, brighter days might be on the horizon for renters, at least in certain metro areas, as national rents decreased by 0.7% from September to October 2022, reflecting the first instance of consecutive months of negative rent growth since the start of 2021. Additionally, the prospect of outsized rent growth led to the planned development of many new rental housing units. 700,000 rental units are currently under construction in the United States, and several cities will see the largest historical expansion in their housing inventory, easing the burden on existing supply. Additionally, the second quarter of 2022 was the first quarter in nearly a decade that saw more apartment units completed than rented, indicating we are moving closer toward a supply and demand equilibrium. On the single-family housing front, mortgage demand has reached a 25-year low as interest rates are more than 2.5 times the previous lows between 1 and 2 years ago. While housing prices will likely decrease as a result of this variable, it doesn't necessarily mean that owning a home will be any more affordable given the rapid increase in rates. For example, the monthly 30-year fixed mortgage payment for a $400,000 home at a 2.75% rate is $1,633. At a 7% rate, the purchase price to match this monthly payment would be $245,500, or a 38.6% decrease. Will the market see this 38.6% decrease in pricing? Signs are pointing toward a decrease in third-party investors in the market as well. Blackstone, one of the most prolific institutional investors in single-family homes, announced that its company Home Partners of America, which owns over 17,000 homes across the United States, would stop purchasing homes in 38 U.S. cities as of September 1st, 2022, and then an additional 10 cities as of October 1st, 2022. This represents more than 50% of the markets in which the firm is active. Given Blackstone's reputation as one of the most profitable investment firms, many other firms are likely to follow this decision. Additionally, there have been an increasing number of calls for legislation to limit the number of investors that are purchasing homes. In fact, this has already occurred in Canada. In an effort to cool off a red-hot housing market where prices climbed over 20% in 1 year, the country announced a 2-year ban on foreign home buying, as well as higher taxes for those who sell their homes within 1 year. Various municipalities within the United States are exploring similar avenues. For example, the proposed California bill called the California Housing Speculation Act aims to discourage the flipping of properties by short-term investors by adding a tax on profits from sales that occur within 3 years of the purchase. Certain cities have discussed new rent control measures as well, and in notably more conservative parts of the United States that have historically been averse to such laws. In November 2022, the city of Orlando plans to vote on an ordinance that will prevent apartment owners from increasing rent beyond the inflation rate seen in that region. While this provides landlords more pricing leeway than other municipalities with rent control measures, and the effectiveness of rent control on long-term rental prices can be debated, it certainly reflects a notable proposal from one of the largest cities in Florida. On the other hand, certain metropolitan areas will continue to see expansions in their employment base and increase in average wages. For example, when a major high-wage company announces an office relocation or expansion, they are likely increasing the average income in a neighborhood or city, which will ultimately trickle down to an increase in the amount the new, more well-off resident population is willing to pay for a home. This can be seen by looking at Austin, Texas. Over the past few decades, the city has seen its employment base evolve to become home to one of the most prominent tech hubs in the nation, home to Amazon, Google, Apple, and more. High-tech employment grew by 62% in Austin from 2010 to 2020, well surpassing the national rate of 17%. Austin saw its median household income increase by approximately 47% over the same time period, much higher than the national increase of 15%. Uncoincidentally, over the same time period, rents in Austin rose faster than any other city in the nation. Will supply be able to keep up in the areas that are the beneficiaries of population growth, income growth, and job growth? Construction challenges persist, and the ease of zoning and entitlement vary by metropolitan area. In 20 years, how close will rents in states like Texas be to those in California? What city, if any, will follow in Austin's footsteps? If the past years taught us anything, it's that major economic changes can happen quickly.